Your city's new pavement is a ticking time bomb for your bank account. As Nairobi keeps growing, every new estate, every new road, every new stretch of concrete turns your street into a high-speed river the moment the rains come. And here's the part nobody tells you. Your standard home insurance policy is probably still stuck in the past. If a flash flood hits tonight, the coverage limits you signed up for years ago could leave you hundreds of thousands of shillings short on reconstruction costs. Today, we're breaking down exactly why and what you need to do about it before the next storm. Topic 1. The concrete trap. Let's start with the streets themselves. 2026 urban density has quietly turned our neighborhoods into something they were never designed to be: drainage channels. Every parking lot, every rooftop, every paved compound is a hard surface that rain simply cannot soak into. In engineering terms, this is called impervious surface runoff, and the physics are brutal. Water that used to sink slowly into soil now has nowhere to go but sideways downhill and eventually into your basement, your boundary wall, and your foundation. This isn't a once-in-a-decade freak event anymore. It's what happens on an ordinary heavy afternoon in a city built faster than its drainage was ever upgraded. So the physical infrastructure is failing. The real question is, what happens to the financial safety net you thought you had in place when it does? That's where things get uncomfortable. Topic 2. The policy limit illusion. Here's the trap. Most homeowners are walking around with a policy that was priced for a different Kenya. Standard inflation guards built into policies written even 2 or 3 years ago simply were not designed to keep pace with 2026 reconstruction realities. Cement, steel, skilled labor, all of it has moved. Your policy limit hasn't moved with it. This creates a widening gap between two very different numbers: the market value your policy was benchmarked against, and the actual skyrocketing cost to rebuild after a localized disaster wipes out your home. And this gap isn't theoretical. It's the exact mechanism behind the total loss claims we're now seeing triggered by flash flood contamination, where water damage is so severe and rebuild costs so inflated that your payout simply cannot cover what it takes to put your home back together. You didn't underinsure yourself on purpose. The market moved, and your policy limits stayed behind. Topic 3. The drainage failure trigger. Now here's where it gets technical, and where a lot of homeowners get caught out at claim time. Modern municipal sewage backups are legally a completely different animal from traditional overland flooding. Your policy may cover one and quietly exclude the other. Most people never find out which is which until they're standing in a flooded living room reading the fine print for the first time. And here's something counterintuitive. A total loss claim often has less to do with how high the water rose and more to do with structural erosion, the slow undermining of foundations and walls that happens when contaminated water sits and seeps for days. This is exactly why insurance adjusters are increasingly denying these modern claims, not because the damage isn't real, but because it doesn't fit neatly into the technical definitions written into decades-old policy wording. Topic 4. Data lag and premium risk. So why is this happening at scale, across the industry, and not just to a few unlucky homeowners? Because the historical flood maps insurers and planners still rely on were built for a Kenya that no longer exists. They simply do not account for the new urban normal of 2026 precipitation patterns: shorter, more intense, more concentrated downpours hitting harder surfaces than ever before. Meanwhile, on the other side of the industry, AI-driven risk assessments used by banks and underwriters are moving faster than the actual coverage limits being offered to homeowners. The data science has caught up to the new reality. Your policy document has not. This is a systemic data problem, but it has a very individual solution. And that solution starts with you today, closing the gap yourself, instead of waiting for the industry to catch up. Topic 5. Recalibrating your coverage. So what do you actually do about it? First, audit your extended replacement cost rider. Confirm it reflects current labor and materials costs, not the estimate from when you first bought the policy. Current labor shortages alone can blow a modest gap into a massive one. Second, treat sewer backup coverage as its own line item, not an assumption bundled inside standard flood insurance. As we just covered, these are legally distinct perils. If you haven't asked your broker specifically about this endorsement, you likely don't have it. Third, don't wait. The next seasonal storm surge is not a matter of if, it's a matter of when. Updating your policy limits today costs you a phone call. Discovering the gap after a flood costs you everything the payout doesn't cover. Your home is only as protected as the numbers written into your policy. And this year, those numbers need a second look. If you want help auditing your own cover, that's exactly what we do here every week. Subscribe, and let's make sure the next storm finds you ready.